Jain is a finance professional with over 10 years of experience in banking and different markets. He's the co-founder and CEO at CWISE Capital Limited, which is a UK-based trade financing company which provides Indian exporters financing facilities for their commodities. For this seminar, we would be covering the aspects related to trade financing and the problems and various other issues that are pertaining in this particular field. So over to you, Vidur. Please walk us through the presentation, and in the end, we'll take up some questions from our viewers.
Okay, great. Yeah, hello everyone, and welcome to the webinar. And thank you for Kogoport for organizing this. So yeah, as Abhilash mentioned, we are basically a trade finance company. So we provide post-shipment trade finance, which is different to the banks. So I'll go through kind of what post-shipment is, what need we are fulfilling, and how the product works. So essentially what's happening is, I think until date, like most of the exports which go out of India have been done with advance payments or payments on delivery. But typically US and Europe especially, those markets are moving more towards credit terms where buyers want extended credit periods and they can go up to 90 days or even 120 days in some cases. So that means exporters typically have cash tied up to invoices for those periods of time, and they cannot be competitive because unless an exporter has that kind of cash in his bank account, they will not be able to service those clients because they'll go with someone who is offering those credit terms. Another is obviously because of they're geographically apart, often exporters don't know who the importer is. So extending credit terms for high value shipments can also present a risk to them because there's a credit risk. What if the buyer goes away or anything happens? How will then exporter based in India chase an international buyer? So there are financing options available from the banks. However, currently what Indian banks are offering is not what is true trade finance, because essentially what they offer is a collateralized facility where you have to pledge some hard collateral such as a plant or some land or something, based on which they'll give you a limit. Now, if you're an exporter who's trading many times over your asset value, that means you can't get the finance that you need to fund your shipments. So, you're still in the same situation. Another thing is banks have it on full recourse. So if your importer goes default or runs away, you have to essentially be on the hook for that payment. So it presents a lot of risk, and they're slow. So it can take months to get a facility approved, and then there's a lot of paperwork involved. And on top of that, they require ECGCs or LCs to be in place, and which have an additional cost, which has to be borne by either you or the importer. So this is essentially, this was the problem that trade finance was created to solve. So essentially when global trade started, that was the genesis of trade finance itself. So over 5,000 years ago, there were debts being recorded in Mesopotamia, then in Egypt and Greece. They started doing cross-border trade and they started recording debts on paper. The Roman Empire then spread the concept of trade finance. In fact, the word factoring comes from the Latin word facere. With the spread of the Roman Empire, it got to the UK and France, and then essentially they then spread it to America. And then in America, when common law factoring began, that's essentially what created what modern day factoring is. So how does factoring work? So factoring is essentially a third party like us buying your receivables at a discount. So let's say you have an invoice for $100,000 to a buyer in America, and you'll get paid 120 days later. We will give you 80% of the shipment today once the goods are ready, and we will collect the and we'll collect the rest of the money from the importer once the invoice becomes due. So that means you have your cash freed up, which you can then use to finance other shipments, and you have credit protection as well. So if your importer goes bankrupt or defaults on the payment, you are secured for that $80,000, which we have already funded you. No collateral is required, so this is transactional banking. So we will underwrite the exporter and the importer, and it's fast and online. So essentially, if you look at like bank charges, so factoring with a private company is more expensive than a bank because banks are secured. So typically, total bank charges you're looking at are 7 to 8%. With the factoring company, it's 8 to 10%. But then the fact that it includes insurance and it's faster, it's helpful for exporters because you can actually grow your business many times over. But the cost difference is not that high. It's 1 or 2% essentially. This is how a transaction works. So basically, once your goods are ready, you'll ship your goods to the importer. You put a notice of assignment on the invoice to say that, okay, your factoring company, let's say CWise Capital, is now in charge of those goods, and the invoice is assigned over to us. We will verify the invoice with the importer, make sure that they're happy with paying us, they're happy with the invoice period is over. The importer will pay us the total value of the invoice. We deduct our principal and the fees, and then the remaining 20% is put back into your bank account, after which you can realize your BRC and focus on other shipments. So the onboarding process, typically, it used to be longer for the older factoring companies. Now with fintechs like us, it's getting more and more faster. So typically we can turn around in less than a week, where we can come back, do all the underwriting, everything is online, and give you an offer and have a facility up and running in 1 to 2 weeks. This is also, so there have been questions asked on whether this is compliant and it's allowed by the RBI. So it is compliant by the RBI. There was a master circular dated 1st of July, which says that foreign factoring companies can discount export bills. So it's compliant with RBI and the FEMA rules as well. So just to give you a bit of a background about us, so we're a relatively new company. We're a UK-based company. We provide post-shipment trade finance to Indian exporters. The export markets can be anywhere in the world. We have some large investors behind us, including Y Combinator, S28 Capital. And we work with Indian exporters across different sectors in commodities to manufacturers as well. So that's the end of the presentation. If there are any questions, I'd be happy to take them now.
Thanks, Vidhu, for your insights. Now it's time for Q&A. We understand due to shortage of time, we will be able to take only 3 questions, and others will get an email reply to their particular questions, let's say. Our first question is, how can we handle the shortage of trade when the rejection rates for trade finance are more than 50% in a developing country? And how can an MSME overcome with such rejection to increase his trade exposure?
So essentially, these rejection rates come from banks. Now, banks are not equipped to offer this kind of trade finance because you see, there's so many moving parts. Like you have to underwrite the exporter, you have to underwrite the importer, and then you have to look at the actual goods. It's a very fast-moving, fast-turning kind of asset. So you need a specialized player like us, where we can come in, we can sit in, and we can look at all of those things. So a bank will typically reject, the 50% of the people they'll reject will be ones which don't have any collateral to pledge, essentially. So of those 50%, we can actually look at kind of the quality of the exporter and the quality of the importer, and then give limits based on that. So that's why our acceptance rates are a lot higher than what banks would accept for typical trade finance.
All right. Our second question is, how can cross-border trade finance be benefited via an Indian MSME who has just started contributing about 30% of the total trade?
Sorry, could you repeat the question, please? It got cut.
How can cross-border trade finance be benefited by Indian MSMEs who have actually contributed more than 30% to our total trade volume?
A total trade volume of their trade, or?
Yeah.
So yeah, like I mean, it depends on what stage you're at, right? Like typically what happens is you have some companies who are pure exporters, and then others who are doing kind of like a mix. So they're selling in the international market and they're selling in the domestic market. For us, it doesn't matter. Like as long as you're a sort of fairly regular exporter, you don't have to be doing some large number of volumes or anything like that. Like as long as you're a regular exporter and you have a relationship with your importer and the importer is of good quality, we can provide limits basically.
Okay. And the last question would be, how fintech companies such as CWise Capital would enable effective and efficient movement and mobilization of cash flows for our shippers?
So by coming up with these kind of solutions which banks are not offering. So for example, like now the fact that an exporter doesn't need collateral to access finance means they can grow their business, they can fund more shipments and buy more raw material. Another is obviously like on our side, we can get underwriting and everything done very quickly. So typically once we have a funding request, after we've set up a facility, we can make sure that the exporter gets the money in their bank account in less than 24 hours. So rather than having to wait like a few days or a week or something, you get paid a lot faster. And that's all because we leverage kind of new technologies and new ways of doing stuff.
I would request the audience, if there's any question right now, you can ask Vidhu.
So there's one question which is, do you also provide trade finance for startups? So typically we look at like at least they should have 6 months of trading history with an exporter. Like a lot of other finance houses will look at 2 years, 3 years. For example, I think the ECGC looks at 3 years of exporting experience. So we are a bit more flexible. We can't do it to a complete startup because one of the risks in trade finance is commercial dispute risk, right? That whether the goods will be up to scratch, whether the importer accepts the goods. So we look for kind of where there is like a little bit of an established trading relationship, and we fit into there.
Vidhu, one question that many of the shippers right now have, this understanding in the industry that whenever you are catering to demand, such as countries in Africa or Zimbabwe, many of these banks and investment companies are avoiding these particular routing, or even you're talking about routing of transactions or commodities. So you wanted to understand what is the actual reason, regardless of how the economy is actually working. Wanted to have an understanding on that.
So the thing is like, because there is like Africa as a region presents a lot of country risk. So even fintechs will be a bit hesitant unless they have kind of local partnerships there, because even bank LCs, there are no like banks in India, for example, do not trust an LC from an African bank because there have been cases of them not being honored. So it is slowly changing. Like there are regions in Africa, like South Africa, Kenya, etc., which is improving, and there is innovation happening there. But still, as a country, it just remains like just with a high country risk, where the perceived business risk is really high. So even Middle East is kind of regarded a little bit risky. We can do like, obviously, like as a fintech, we can look at those regions and assess them. But then banks, etc., they look at the country risk, and it will be a flat yes or no.
Okay, I guess this is about it. So thank you all for being a part of this webinar. I hope you all have learned a lot. And for people who have not received answers to their queries, we'll ensure you get an email with the answers for the same. We also have 2 more webinars coming up this week. Do check them out. And thanks, Vidhu, for joining. And as always, for better trade and shipping, do visit coopert.com. Thank you.
Thank you, everyone.